Good morning, good afternoon, good evening, whenever you're watching this. It is Ryan Speltz, your Kick Butt Mortgage Guy, and this is, I believe, our second episode of Ryan Speltz Kick Butt Mortgage Guy Presents. And today we have on an awesome credit repair agent, the CEO of Rescore Your Life, Janna Fox. She is the preferred credit repair agent that I send all of my clients to. She is fantastic. She gets things done on time. Has a great woman-led and women-driven business. And so I wanted to bring her on to educate us a little bit on what we can do to help our clients. And a lot of this information is going to go over well directly to clients as well. So if you're on here watching and want to learn a little bit, you're in the right spot. So Janna, I'll let you take it away and you just tell me when to flip on your slides. We'll be good to go.
All right. Sounds good. Thank you so much, Ryan. I'm really excited to be here and I guess meet your agents, kind of, through this. So anyway, I think it is so important, especially when you're in the industry that we are, where we're helping people reach their lifetime goals, right? So they want to be homeowners. That's the American dream. But there's a lot of things that get in their way or maybe keep them from being able to do that. So when you understand credit, because let's be honest, that's the huge piece of it, right? So when you can understand credit and be able to help them to the next level, or help them reach their goals, that's absolutely rewarding. So one of my goals is just educating real estate agents and loan officers so they can help their clients and get rid of the misconceptions, I guess. So we can go ahead and slide on over to my slides. Am I echoing?
No, but I do see our faces before I pop up the screen share. So you're going to want to move that other window off.
Yeah. There you go. Is that good?
Yep.
All right. I'm a little bit sideways, but that's okay. All right. So like I said, one of the things that I think is very important is that we're able to debunk, if you will, a lot of the credit misconceptions that are out there. And there is a ton. And remember, anything that you find online is self-serving, right? So you really want to make sure that when you're finding information about credit, it's actually legit and you're passing good information on. So that's one of the reasons why I made this presentation, and the items that we talk about are things that I heard that were the most common misconceptions. Of course, there's a lot more than just what we're showing here, but this is the most common. If you have any questions, feel free to ask. I guess you can just can't they just make comments or something like that?
Yep. Yeah, they just post a comment like normal. We can pop it up on screen and go ahead and answer it. And I've got the banner down below reminding everybody that too. So
cool. So I am totally fine with answering questions, and I would rather you stop and ask rather than thinking about your question and maybe missing some stuff. All right. So like you said, my name is Janna Fox. I am the co-founder and CEO of Rescore. I've been in the credit repair industry for going on 12 years, believe it or not. And it's rewarding, that's for sure, but it's definitely something that daily I have to just be like, oh my God, that was terrible advice that you gave your client. So like I said, I love educating. So we're going to dive right in. This is just about me, so we don't need to talk about that. And it's about Rescore. Okay, so today I will show you how the collection companies report incorrectly on purpose to the credit bureaus to harm and lower consumer scores. You will discover why the collection companies do this, and unfortunately why very little is being done about it. You will learn how to spot out errors on credit reports and understand why it lowers credit scores to pay off a collection, how much damage is caused each time credit is pulled, and a few tricks to improve credit scores quickly. So credit misconception number one is people with bad credit, low credit scores are lazy. They don't pay their bills. They don't deserve to be homeowners. That's absolutely incorrect. As long as I've been doing this, of course, you're going to run into a couple handfuls that that's the case, but typically it's not at all. So it's people just like you and me. And what's happened is life has kicked them. Life throws lemons at you, whatever. So it's either like a job loss, unexpected medical issues, a divorce, a decrease in income, or no credit established. And the important thing is education is key. And so what you want to do is you want to remember that credit, it's a credit rating, not a character rating. So really, anytime that you run across somebody that has poor credit, one or two things are going on. It could either be like they don't make enough money, or it's a budgeting issue, or they don't know. That's really what it boils down to. And so when you can find out and peel back the onion layers and figure out which one it is, then you can work with that. And credit misconception number two is you only have one credit score. Okay, now I'm going to dive into this a little bit deeper, obviously, than the slide before. And this is the reason why. There is so many misconceptions when it comes to scores that you find online. I don't know how many times you've probably heard you have a client, they're like, I know what my credit score is. I'm at, let's say, a 720. And you're like, oh, that's fantastic. That's great. How do you know that? Well, because Credit Karma told me, right? So the online scores are good to monitor your credit, kind of get an idea, but is not a good way to actually figure out what your credit score really is. And it causes a lot of confusion for consumers. So the reality is the scores that you find online are not your actual FICO scores. They're called Vantage scores. And then different lenders may use different weights within your FICO score. So there's 56 different versions of FICO, 56. So in the mortgage industry, they use the oldest version of FICO there is. So typically I'll say if I'm working with clients, let's say I'm doing a first time home buying seminar, or, we're doing just some kind of consumer friendly seminar, I'll say that the mortgage industry uses FICO version 4. Now, technically, since you guys are in the industry, I'll get a little more deep with this. So the mortgage industry uses FICO version 2, 4, and 5. All right. And of course, it's a tri-merge. And so then with that middle score, that's what they pull from. The mortgage industry uses the oldest version of FICO, and I don't see that changing anytime soon. It would literally cost billions of dollars to do so. So it's not your mortgage guy down the street that decides what version of FICO it's used. It is industry wide, no matter where you are in the United States. That is what the mortgage industry uses. So the oldest version of FICO tends to be a little bit lower than what if you would go and get your credit pulled, let's say for a credit card or a car loan, something like that. They're typically using FICO version 8 or 9. All right. So in the mortgage industry, they weigh everything very heavily. Do you have high balances on your credit cards? Do you have a few lates on your payments? Just anything like that. So you'll tend to see that scores are a little bit lower. Now let's go back and talk about online scores. Online scores, or actually what they're actually called is Vantage scores. They are not calculated anywhere near the way FICO scores are. And the grading model itself is different. So they typically start out at a 500 and then go up all the way up to 900 to 1,000, just depending on where you pull it from. Okay. So within FICO itself, they usually start out, depending on which bureau you're pulling from, TransUnion, Equifax, or Experian, they start at anywhere between 300 to 350 and they end at 800 or 850. So there's already a big discrepancy there. So you'll see a lot of times when someone has their scores online, they're typically anywhere between 50, 80 to 100 points higher, just depending on what's going on. Vantage scores grade very heavily on credit card usage. Also, ironically, if you monitor your credit yourself, you'll see that there's a lot of advertisements for credit cards. So if someone has a higher FICO score than what they thought they did, the likelihood of them applying for other loans or other credit cards is very great, right? So it's kind of a marketing ploy. Now, I'll tell you what's good about Vantage scores. It's a great way to kind of monitor, or you are monitoring your credit, but it's a great way to kind of see where your credit's at without getting a hard hit. So you can look up your Vantage scores online as many times as you want in a month. It may cost you money, but it's not going to cost you points. All right, it's taken from your FICO score. FICO itself, anytime you get your credit pulled, it's a, if you will, a ding against you, right? So everybody knows that. So it's a good way to monitor your credit to see where you're at. You just can't say, this is my FICO score. And so when you have your clients that say that and say, oh, I got my scores on Credit Karma or, ID Club or anything like that, keep in mind, make a mental note. It's probably going to be lower once I send them over to Ryan, but that's not Ryan's fault. He didn't pull her credit one time and take all these points. Okay. It's just graded very differently.
What about myfico.com, Janna? Is that, I've heard that that's kind of like the closest one to that, and you can get that monitoring. Obviously it's not free, but
yeah, that's actually, I believe that is pulling from FICO version 8. And so that's going to be more like, it's going to give you a great idea if you get your credit pulled to get a credit card. They're pulling from the same. So that's a really good one. And it is closer. You're right.
Okay.
I would say when I've seen a lender report next to that, I've seen it be like 30 points different instead of 80 to 100.
Yeah. I've actually seen some that are really, really close. Because they have, I believe in myFICO, they have the option to pull 2, 4, 8, 6, whatever. So they can take a look at all of those. And obviously, we know which ones we use, which is 2, 4, and 8. So we're able to kind of compare to those, and they're actually, a lot of times they're very close.
Yeah.
I just didn't know if there was an effect or anything like that with the myFICO.
Yeah, no, that's a really good one. And I think that they're getting better ways for consumers to get a closer view of what their actual FICO scores are. And here's the other thing too, your FICO scores change all the time, depending on when they pull it right then. Like I could pull the weather for Kansas City right now, and I'm going to get that it's gloomy and it's raining and it's 50 degrees. But it's not going to tell me what it was a week ago or a month ago. And I think people have this false impression with their credit that it's like this picture of like, oh, for a year, my credit's been like that. It's what's going on right then at that very moment.
Yeah. And I have a chapter in my book that talks about that, how credit is just a snapshot in time. And that's the way that I describe it is like, you're literally just taking a picture of what your credit is at. And then obviously that picture can't go forward or backwards. It's just that specific time.
I really like that. I think I'm going to start saying that. It's a snapshot of time. Yeah, you're exactly right. It's what's going on right then, that very day. And
that's where, when you're asking consumers, and I try to explain this as much as possible, but when you're asking clients, what's your credit score? They probably don't know. And like you said, they think that it's this because of Credit Karma or whatever. Yeah. But even if they did know, they would have had to check it that morning or that minute, because there could have been something that reported from when they pulled it the day before.
Yes, you're exactly right. Yeah, absolutely. That's fantastic. So another misconception is anytime you have your credit pulled, it significantly damages your credit score. So this isn't actually accurate. I see a lot of people really get gun shy. Let's say you're working with a client or a buyer, and they're maybe working with a lender you're a little kind of worried about. You're like, oh, I'd really like you to go talk to Ryan. He does a great job. I know that he's going to be able to help you, throughout this process. He's very knowledgeable or whatever. And they're like, oh no, because I already got my credit pulled. Okay. So it's really important to remember that consumers have what's called the right to shop. Okay. So what that is that's a 14-day window that they can shop as many mortgage companies as they want to. And when I say as many mortgage companies as they want to, I mean it. If they want to shop, which would be absolutely ridiculous, 99 mortgage companies, they can, and they're only going to get hit, if you will, with one inquiry. Okay. So it's a 14-day window. Ryan, don't let me forget, because I want to say something else to say if you look that information up on the internet, because this kind of causes some confusion. So a good rule of thumb is you don't want to get your credit pulled more than 10 times in a 12-month period. If you do, that is when it can start negatively affecting your credit score. And even if it does negatively affect your credit score, it's a percentage. So it's not going to be like, oh, you got your credit pulled 13 times. Now we're going to take 25 points from you. It's a percentage. It's about 2 to 3%. It could go up to 10%. All right. Now, when you're wanting a mortgage, you want your scores as high as possible. So am I saying go out there and like start getting your credit pulled like crazy because it's not a big deal? Absolutely no, I am not saying that. You need every point possible. Plus, it's a big kind of red flag to underwriting. You're like, why are you getting your credit pulled so many times? Kind of weird, right? Something must be going on. And usually when people are getting their credit pulled over and over and over again, it's because they're getting denied different places and they just keep try their luck. So it's a red flag. But it will go up to 10% that it harms you. So it's 10 times in a 12-month period is pretty reasonable, actually. Now we'll go back to this right to shop. If you look online, let's say you're like, you know what, I'm going to check and see if Janna is actually accurate. And please do that. Anything that I say, if you guys want to double check, I would rather you do that. But if you look online, like Google, the right to shop, or how many times can a consumer shop different mortgage companies, you will find instantly, like the first part of Google, like the first couple ones that show up, it'll tell you 45 days. If you read the fine print, it'll tell you that is for FICO version 8 and 9. Okay, so on 8 and 9, it's not going to ding you. You do have 45 days, all right? Within the realm of the mortgage pulls, and we're just going to say for easy sakes, they're pulling from FICO version 4, you have that 14-day window, all right? Now, 2 of the bureaus, you actually have 30 days. Now, if you tell your consumers, hey, you have 30 days to shop, but one of the bureaus is 14, what do you think they're going to do? Okay, they're going to be like, oh, they're going to remember, oh, I have 30 days. So I try to be cautious. So I say you have 14 days to shop. 2 of the bureaus, you have 30 days, 1 bureau, 14.
And what is the impact on that then if they were to go over that timeline? What is it? Is it just another couple points? Like what is...
That's a great question. It depends on what, and I'm not trying to like beat around the bush. It depends on what else is going on with the credit. So if this person is going and getting their credit pulled just over and over and over again, then, and it's another inquiry, then they're like, what is going on? So you're going to get a bigger percentage, but remember, it's only up to 10%. You'll see a lot of times when someone goes shopping at a car dealership.
Yeah.
They'll just get flooded with inquiry. Yeah. So you'll see a lot of times with that, because there's too many in like 1 to 3 days. Typically people are shopping for a car for about maybe 3 days to a week. You'll get that 10% taken from you because it's just too many times. So they're trying to slow that person down.
I think the most inquiries I've ever seen was 59, and like 52 of them were from credit or from a car dealerships.
Oh my God. That's ridiculous.
Yeah. Try to explain all those, because you gotta write out why those are all there.
Yeah, exactly. Good Lord. Yeah, it can get crazy. Oh, and this is another really important thing too with the inquiries. Understand that it's on a rolling calendar. So it's not like January 1 to December 31st. It's like June to June, September to September, so it's on a rolling calendar. And then, like I said before, it's a percentage of your FICA that's taken. It's not a set point. So is it something you need to be aware of? Yes. Is it the doom and gloom that a lot of people have this false impression it is? No, absolutely not. And then misconception number 4 is keeping your credit card balances at 50% will improve your credit scores. I don't hear this as much as I used to. There's a lot of consumers that still have this false impression, but credit cards are a fantastic way to manipulate a FICO score in a positive direction if you know how to work the system. So I'm going to teach you really quick, and I'm telling you, this is like almost magic. So if we look at our credit card balances versus a limit, like we had a grade card in school, right? If your balances is 0 to 10%, you're grading in an A. 10 to 30%, you're grading it a B. 30 to 50%, you're grading it a C. 50% and above, you're grading it a D. And any late payments in the last 24 months, you're grading it an F. So this is all an algorithm, right? So statistically, if you have a late on any type of payment, your likelihood to have a late again the very next month is very great. So they really just like take your scores and they just drop them significantly because they're trying to stop any adverse reaction happening. Like, whoa, 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 whoa. Something must be going on in their life. Let's lower their scores as low as possible. That way they're not going out and applying for all kinds of other credit cards to try to, this snowball thing starts happening. So I'm going to tell you a trick too. The sweet spot for credit cards is 3 to 5%. I'm not saying 35%, 3 to 5%. That gives you the most points possible on your FICO score with that credit card. So it's actually better than a 0 balance. And you have to remember, a lot of people are like, oh, I paid my credit card balances down to 0. That's good, but it's actually so much better to have that balance at 3 to 5%. The reason why is anyone that reports to the credit bureaus, it costs them money. If you're sitting at a 0 month after month after month, you're costing that company money. So they want you to do that. They want you to spend money, right? It's credit cards. So if you can do that 3 to 5%, so I would say 30 to 60 days before you go to apply for a home loan, car loan, another credit card, pay your credit card balances down. If you don't have a lot of cash to do that, another thing that you can do if you've had your credit card open for a year or more, you have great pay history, you can call them, ask to raise the limits. That is not an invitation to go shopping at all. Like, don't do that. Don't do it. But what you're trying to do is you're trying to get a bigger balance between that, a bigger distance, between that balance and that limit. All right. And then keep your credit cards open until your grandchildren have children. Not even joking with that. It's so important. One of the things, and Brian, I'm sure you ran across this, you'll have someone that starts getting the bug to get a house, right? And so they are doing what they think is best. So they'll pay their credit card balances down to 0, and then they close them. And you're like, oh my God, like that you don't want to do that. You have to have trade lines, all right? You have to look at trade lines.
Pay off their car loans and everything goes away.
Yes. Yeah. Actually, this weekend, I was just talking to a gentleman that he was a vendor. And he was telling me that him and his wife, they're like so excited. They're so close to retirement. He paid off his car or his truck, her car, and their house. And then he has these big plans. He did this like 18 months ago. He has these big plans to get this great place out in the country, and they're going to retire there. And I was like, oh, what did you do to replace those trade lines? He's like, oh, I didn't. Like, we're living on cash. And I was like, oh, yeah. Okay. So at break, I went over, I'm like, I don't want to get in your business, but this is what's going on. He was floored.
It's a lot of times people think that it's your ability to pay off debt. It's not. It's your ability to manage debt. It's your ability to be able to stick with the debt for what you have it for.
Yes. You're absolutely right. That your FICO score is not based on never based on if you're out of debt. Your FICO score is based on how well you handle your debt. And credit cards are not a substitution for money. They are a tool to get high FICO scores so you can get better interest rates, so you can get that better house and so on and so forth. So you're exactly right. So it is a tool, not a substitute. So that's really, really important. So anyway, 30 to 60 days before you go into apply for a loan or your clients do, pay your credit card balances down to 3 to 5%. That's the sweet spot. You're going to get the most points possible. Fantastic way to manipulate a FICO score in a positive direction. I always have people do that first.
So before you move on, I wanted to ask about the 3 to 5%. I get a lot of questions on, well, I paid them down, and then they don't understand that if they use it again the next month, then it reports a balance again. So right. Can you explain the breakdown of when to pay those down? Because I know that's a huge question among people.
Yeah. So what you want to do, and every credit card company reports at different times. There isn't a magic day of the month that on the 15th, all credit card companies report. So what you want to do is when you get your statement, the date that's on that statement, it's typically about 5 to 6 days before that they're reporting. Okay. So that's to help you out. That's why I always say 30 to 60 days. Because then that way
5 to 6 days before the statement date?
The statement date, correct.
Okay.
So, and you can call too if you want to. Now, typically the person that answers the first time, I mean, they won't probably know, but you can get escalated to a manager or something like that. But a good rough estimate, you can figure it out on your own, that statement date, and it's about 5 to 6 days before that they're reporting. Okay. So that's the other thing too that will happen. People will be like, they'll call in a panic because they paid their credit card balances down, but then they got their, they went to a lender, got their credit pulled. They're like, this is wrong. They're showing that I have a balance of $200 and I paid it off. I'm like, well, what date did you pay it off? Well, yeah, you paid it off after they reported. So don't panic.
Does it report the previous month's statement then?
Correct. Well, it reports. So whatever's going on, let's say that you have, they report on the 12th of the month. So whatever the balance was on the 12th of the month.
Okay.
And let's say you pay it off on the 14th. But whatever the balance was on the 12th of the month, and that's when they report, that's what it's going to show. So that's what, so you want to make sure that, and that's why I always say 30 to 60 days, just that gives you plenty of time to get it paid down and to report. Here's the other thing too. You don't want your credit card balances to be a $0 amount for more than 90 days. If you do, it starts going dormant, and also a lot of times they'll close you out. So you have about a 90 to 120 day window. If you want to go put a tank of gas in your car so you don't get all crazy with your credit cards, do that, but just make sure there's a little balance on there. And the credit misconception number 5 is paying rent, utilities, cell phone bill on time, and not having any debt, such as credit cards, mortgage, personal loan, or car payment, will give you a high credit score. That's not correct at all. So you have to look at trade lines like homework. So if you don't turn your homework into the teacher, they have nothing to grade you off of. If you don't have trade lines, FICO has no way of knowing if you're a risk or not. Okay, so you're up in the air if you are or not. So having a thick credit profile is 3 to 4 trade lines with history. If you only have credit cards or you only have installment loans, which is a home loan, auto loan, or personal loan, your scores will be 10% lower than they could be. So a good, healthy mix is very important. And then this is the other thing too, I'll get asked. If someone is just now starting their credit journey and they'll say, what's better? Should I get an installment loan or a credit card? Credit card's always the best way to start, or the best trade line to start with. It's also an easier way to manipulate a FICO score. Now, interestingly enough, when you're a brand new infant baby in the credit game, when you open your first credit card, you have to have credit for 6 months in order for it to produce a FICO score. Now with Vantage scores, that first month, within like 30 to 60 days, you're going to produce a score. Keep that in mind. I've also had brand new people, they open a credit card and then they go 3 months later, they go talk to a lender and they're panicking, and the lender's panicking because they don't have a score. Well, it's because they haven't had enough time to calculate one. All right. And we'll talk a little bit later on what we can do when you're a brand new infant baby in the credit card or like trade line game, to tell you what you can do. Because a lot of times you'll hear too, you can't get credit if you don't have credit. That's true. So I'll tell you what to do to get past that. So like I said, look at trade lines like homework. If you don't turn your homework into the teacher, they have nothing to grade you off. So you need credit in order to produce a credit score. Okay. And then the other thing, I wrote a blog, I think I put it on my website. But anyway, it was talking about, people were asking, how do you get a perfect credit score? And they did all this like information. And interestingly enough, people with like the 850, around like 835 to like 850 range, they had 6 trade lines, but their balances, or as much as they were in debt, were, not over $2,500. Interesting, right? So that is your magic 850 realm. Okay. What's interesting though is even if you have an 850, it's not like all of a sudden like the world and the gods open up to you. It's once you get to like 780, you're doing fantastic.
Yeah, for a mortgage, it's anything over 760 and up it's all the same. So.
Yeah. So you can do that for bragging rights, honestly. Like I'm in the credit repair realm. You can imagine what I see. So when I see someone with very, very high FICO scores, I'm like, wow, that's great. But I've never seen angels come down or, our Lord and Savior come down and pat you on the back. So once you get, like he said, like the 760, 780, you're doing excellent. And you really do need to pat yourself on the back. So.
Yeah, I just pulled an 804 and a 759, and they're going to have about 1/8 of a point difference in price. So it's going to cost the person that has the 749 or the 759 is going to cost them about $200 more on their interest rate. So it's not even that big of a difference at that high of scores.
Right. You're exactly right. Yep. And the credit misconception number 6 is paying collection that shows up on your credit report will improve your scores. All right, you guys, this is so extremely important to understand and wrap your head around. So paying an old collection will update the date of last activity and date reported, and it can take anywhere between 50, 80, or even 100 points. So the more points that you have on your FICO, the more points they'll take from you, unfortunately. All right, so that's the reason why there's that discrepancy there of how many points. So there's less than a 2% difference whether a collection is paid or unpaid. Most weight is given to how recent the activity. All right. So what happens is when you pay a collection that, let's say it's a 3-year-old collection from the emergency room, right, that you thought your insurance paid, they didn't pay, then you pay it updates, but now it says paid collection. It doesn't remove it. Paying a collection that shows up on your credit report does not remove that line item. It just shows paid, then changes the last day of activity, which lowers your scores. So what you need to do instead of just paying it is you need to call the collection company and negotiate removal, not just report that it's paid. Now, it's very important too, but before you even give any payment information, when you're on the phone with them negotiating, let's pretend like it's a $300 collection, right? Hey, ABC collection company, I'll pay this $300, but what I need you to do is I need you to send me a letter in writing or an email, but it has to have company letterhead. I need to have the person that you talk to, their number, if they have an employee number, the date, everything else. And it needs to say it'll be removed from the credit report, not updated, not satisfied, not paid in full. You will lower your scores if it shows up that way. It'll be removed from the credit report. All right. That's so very important. Once you get that letter, then you give them your payment information, not until then. I want to be very, very clear about that, because if you say, oh, okay, they're like, oh yeah, we'll send you that letter, say it will be removed, and then you don't have it in your hands and you pay them, it's nearly impossible to get that collection off your credit report. I'm just dealing with this guy, very wealthy man, very intelligent man. He went ahead and paid a collection on his credit report, didn't wait for the letter to come in, and we have been fighting it for 6 weeks, and I have to make that phone call today, just let them know they are not working with us, and there's really nothing we can do about it. It's paid, and it's reporting it's paid. So they're not doing anything wrong. Okay, so don't think if you pay it, it's going to get removed. So
one of the exceptions I've seen to that, and not necessarily the removal part, but the ability to increase scores, is when there is a credit card that's actually reporting as a revolving account in the collections and it shows overbalance.
Yes.
I've noticed that is one of the exceptions to that rule where that jumps scores. I mean, I've got one that's working right now. She's got to pay $1,800 on a $1,000 limit. Mm-hmm. And it will bring her scores up like 45 or 50 points.
Oh yeah, absolutely. And I'm so glad that you brought that up to clarify that. So credit cards are a different realm. So what that's going to do is that is bringing her, when you take the FICO pie, that's bringing her revolving accounts in such great standing because they're not over the limit. So absolutely. I'm talking about like medical debt, just the things that show up as a collection. So yeah, thank you for that.
Yeah. The stuff that wouldn't necessarily be on your credit instant or right away until it goes bad, right? Like medical, the Verizon bills and that kind of stuff that wouldn't normally be on your credit until you don't pay it.
Yeah, exactly. You're exactly right. And then credit misconception number 7 is credit reports are accurate. Now, way back in the day, this is a thing that absolutely blew my mind before I was in the credit repair industry. And I was kind of trying to decide what I wanted to do when I grew up. I was well grown up by then, but when I was trying to decide what I wanted to do, I had a very bad taste in my mouth, and I'll go into that story another day. But for credit repair companies, did not like them, felt like they were ambulance chasers, didn't have a lot of respect for the industry until I met a reputable credit repair company that sat me down and showed me the difference in, if you do it the right way, how it actually helps and how consumers are getting screwed over constantly. And then it really changed my perception of the whole credit repair realm, if you will. So 79% of all credit reports contain errors, 79%. So basically what that means is 79% of the people even listening in on this information most likely has errors on their credit report. That's nearly 8 out of 10. That's insane. It means 79% of your buyers, sellers, whatever, have issues on their credit report. There is no other industry in the world that could get by with mistakes 79% of the time, except for maybe like IRS and the weathermen. Like that's weather people. I don't know if you can say weathermen anymore. It's that PC. I don't know. But anyway, so the industry is a very crooked and has a lot of room for improvement. We'll say that. So one of the reasons why there's so many mistakes on credit reports actually is the way they pull your information to gather your credit score. So the way they gather their information, you might want to look at it like they're like gathering with a fishing net rather than a fishing pole. It's very general information, which to me, and I like to be a problem solver, I would think, okay, well, everyone's giving a social security number. So just pull that because that's about that one person, right? And it's going to give you very specific information. And I think a lot of people have that misconception that that's what happens. So truth be known, the way they gather information to get your FICO score, or for your consumers to get their FICO score, they pull zip code first, last name, first initial, and only 7 out of the 9 social security digits. Truth be known, you really don't even need a social to pull a credit score. All right. So here's where you'll run into a few hiccups with that. Let's say you live in a large zip code area. Let's say you live in Orlando, Florida. Your last name's Smith, your first initial's S. The likelihood of crossover is very, very great. Or I can even use my own family, for example. So my granddad, my dad, my brother, and my nephew all have the exact same name. Okay. My dad and my brother have the exact same birth date. There are 7 children. I'm one of 7 in my family. They all live within a 4-block radius of each other, same zip code, except for me. I'm the only one who got out. I freed myself. So anyway, so what happens is I have 2 brothers. They have the same initials. I have brother A that is very responsible. He's owned a house since he was 19 years old. The man just has it together, right? And then I have brother B that we love dearly. We'll say that. So what happens is they get a lot of crossover. They have too many things that are same. They have the same last name. They have the first same initial, and they live in the same zip code. All right. Or like when you see divorce situations or whatever. So you can see that the likelihood of getting a mixed information, it can be very great, especially the larger the zip code that you live in or the more common your last name is. So what you want to do is anytime you have your credit pulled, and a lot of people don't know this, go straight to the addresses that are showing up. If there's an address on there that, let's say, belongs to grandpa that you're named after, or like in my personal family information, my brothers or your new husband's ex-wife, if there's addresses on there that don't belong to you or you don't even know whose they are, you have what's called a mixed file. So it's very important that you go through your credit report and make sure that all of it works well. Now, I have seen it can work bad for you, right? But I've also seen where someone has a very lovely credit score because they have a mixed file. Now, I'm not going to tell you what to do with that. I'm just saying it can work either way. So
I would say that there'd be a hard problem to solve that. I mean, like not necessarily solve it, but to not use it, because everybody's, when they have a better credit score, they're going to go, oh, that's great. I thought it was worse than that. And then you're not going to investigate. But when it happens the other way, then people are upset and you have to do some investigation.
Yeah, you're exactly right. And exactly what you just said, like, oh, I didn't realize my credit was that good. And it's because they pull it. Now, if that happens, what's interesting is we can go in there and we will remove the incorrect address. But what's ironic is the very next time they get their credit pulled, most of the time that address will pop right back on. So we always tell our clients, like this is going to fix this report. But when you get your credit pulled again in another 30 to 60 days to get that home loan, like it's just that is attached with you. So it could be a really big pain in the booty, but you have to like send a letter to the bureaus. It needs to be certified saying this is not mine. This is my Uncle Ted's. I'm named after him or what have you. So
yeah, I see junior and senior a lot.
Yes. Yeah.
That's brutal.
Yes. Yeah. I know firsthand because of my family. And it's interesting because my other brothers, there's 5, They saw my older brother go through that all the time. And then they saw that, like, even my kids having all G's. You know, I know better because I'm in the credit realm, but it's really cute on Christmas cards. So I went ahead and moved forward with it. But when you have the same initials like that, it's just like credit, like FICO score, just like, it's havoc. So anyway, happens a lot. All right. The other reason why there's so many mistakes on credit reports, or that the consumer is really set up to fail from the get-go, is the way the collection companies report to the credit bureaus. So this is the big doozy, guys. So I'm going to go through this pretty quickly because I want to be respectful of your time. But this is what I'm talking about when I say that there's mistakes on credit reports. I'm not necessarily saying that they didn't go to the hospital and get a collection or what have you. But what I'm saying is, for example, let's look at this. So we have Millennial Financial. That is a collection company. It says collection services. There's nothing in the last date of activity. So keep in mind, by law, credit reports have to be timely, accurate, and verifiable. When they are not, then if you have a law piece in your credit repair company, you can do something about it, right? So you're like, oh, you're breaking the law. It has to be timely, accurate, and verifiable. Not having anything in the last date of activity is doing the problem of timely, accurate, and verifiable, right? But here's the big doozy. Do you see where it says in the red rectangle installment? So we all know what an installment loan is, right? It's a home loan, auto loan, personal loan, right? And then it says it's past due by $370. What does a past due installment loan do to your credit? Everybody knows. If you need to sell a kidney to pay your house payment on time, do it. You have to. No, I'm actually don't take that advice. I'm not a medical doctor.
Just half of one of them so that you have the other half in case of another emergency.
Yeah, exactly. Look at us being medical doctors.
Right.
So anyway, so you want to make sure that you pay everything on time. Well, the problem with this is a collection. All right. So it's a collection that's being reported as if it's an installment loan that's past due by $370. That is wreaking havoc on their FICO score. Let's go down here. Primary Financial Services. That is a collection company. This was originally with ADT. Do you guys know what ADT, Home Security, do they loan money? Nope, not at all. I doubt they ever will. There's nothing in the last date of activity. We have that installment word again, and it's past due by $160. So I'll tell you what's happening. The way they're coding it, they're coding this collection as an I-9 rather than an O-9. O-9 is collection, open collection. I-9 is installment. So this particular consumer looks like they have 2 installment loans that are past due, and they're trying to apply for another installment loan. FICO's looking at it like, buddy, you're not paying your installment loans you have now. Like, you have late, like you're past due, not late. I'm sorry. You're past due. Like, what are you talking about? So the FICO scores are very low when they do that. So that's a big, huge problem. So even if they updated, let's say Millennial Financial and Primary Financial Services updated it to an 09, like reported the way it should, it would still improve their scores. Because a collection, don't get me wrong, a collection is not good. Don't go out and be like, oh, Janna said collection wasn't that bad. Yes, it is. It's a big black eye for 24 months, but then it starts easing up. If you have a past due installment loans, it's like you're getting punched in the eye every single month and you don't have time to heal. You're supposed to be able to heal from a collection. When it's posted like this, they're not able to heal. Now, I'll tell you the reason why Millennial Financial and Primary Financial Services and all the other collection companies do this is because it costs less money to report this way. I'll let that sink in. It costs less money to report this way. And the consumer is more likely to pay the collection because it's caused so much damage. And we learned what paying a collection does to your credit. Okay. So you see that this is like this vicious cycle. So I'm going to go through this one really fast. I'm going to read this as if I am FICO and I'm calculating a score for you, because remember, it's just an algorithm. It's not someone behind the curtain in Oz calculating like, Betty's so sweet. She tries to pay her things on time. Let's give her a good credit score. It's all an algorithm. Okay. So we have installment loan past due, $459. Installment loan past due, $375. Installment loan past due, $345. Installment loan past due, $149. Installment loan past due, $100. Installment loan past due, $100. Installment loan past due, $85. So this person has 8 collections on their credit report. 1 is reported the way it should. What do you think that their FICO score looks like? And the biggest problem about this, most of these they're medical and they're very low amounts, $100, $149, $85. Are you kidding me? So that would keep them essentially from purchasing a home, or give them, they would have the highest interest rates possible. That is why it is so important to clean up errors on credit reports and have on there what it really needs to look like. this person does not have 7 installment loans that are past due. They have collections that they should be able to heal from. So it's interesting. Why would collection companies report this way on purpose? It costs them less money. They are more likely to get their money because of the damages consumers go through. But you should be able to heal from a collection. And that is why it is so very, very vital that credit reports read the way they're supposed to. So there are laws in place for consumers. Most people don't know their rights, and they don't know how to point out errors on a credit report. That's why it's so important that the lender that you use, like Ryan, he knows this stuff. He sat through my classes, bless his heart. So he knows to look through a credit report and be like, hey, you know what? This isn't right. I think we need to do something about that, because I want to make sure that your client gets to have the best interest rates possible. So that way they're paying more on house rather than interest. And this is another thing that people don't think about. It's better for the economy for consumers to have low FICO scores. That's insane, isn't it? It's better for the economy for consumers to have low FICO scores. The reason why is low FICO scores mean consumers pay higher interest rates, which means more money circulating in the economy. But by law, credit reports have to be timely, accurate, and verifiable. And when they're not, something needs to be done about it. So that's why there's no one rushing out and trying to help this situation. It's consumers are really getting screwed over quite frequently. Well, 79% of the time, right? And you know what? This is just saying do your research. So I will tell you this, and I'm not going to do a plug for Rescore at all. I'm just trying to do education right now. But when you are looking for a credit repair company for your clients, I think that it is very important that you know 3 things. There are wonderful, wonderful credit repair companies out there that care about their clients, that are trying to help them become homeowners, that aren't gouging them for money. All right. There's not a lot of, if you're working on the consumer's behalf, there's not a lot of money to be made in credit repair. There just isn't. And that's just the nature of the game. But so what you want to look for, there's 3 things you want to look for in credit repair. You want to make sure that they are backed or partner with attorneys. The reason why is, like I was telling you, there's several laws in place for consumers. A lot of people don't know those laws. So it would be like if I was driving down the road and somebody was speeding, and I don't want them speeding. I'm normally the speeder, but I don't want them speeding. So I chase them down. I get out of my car. What am I going to do? Blow a whistle, yell at them, hey, stop. Same principle. When you have a credit repair company that isn't backed with attorneys or doesn't partner with attorneys, there's really not a lot they can do. And to be honest, a consumer can do more than what a credit repair company can, unless they have that backing of that law piece, that they can send out letters on legal letterhead, that they can punch a little bit harder when there's issues on that credit report. So that's very important. So when you are interviewing a credit repair company, ask them, are you backed with attorneys or do you partner with them? Do not assume because someone has the word law in their name that they're backed by attorneys, or that they actually take collection companies or the bureaus to court. Okay. So do your research on that. The other thing you want to make sure is that here's a great business model, but not great for the consumer. If the collection company is putting your client on a month-to-month payment plan, so Mr. Client, you're going to pay $195 a month if we get something removed or not. So on a business model, what word am I looking for? Like a motivation to get things removed quickly. Okay. It's actually better for them if they drag out the process. That's the reason why you'll talk to someone that's been like, oh, I've been doing credit repair for 18 months. Like, I'm sorry, what? Why? So as a business, that's filling their pockets every single month, regardless if something is removed or not. So there's not a lot of motivation. So you want to make sure that you pick a credit repair company that only charges the clients for the items removed from the credit report. So if they go after 25 collections and only remove 15, your client is only going to charge for the 15 they removed, not the 25 they went after. The reason why that's important is because they have so much motivation to get your client in and out of the process quickly. Okay. When I say quickly, be realistic. Like, we don't have wands, credit repair. They don't have wands. We're working with what we can. So it's realistic to think it's going to take about 3 to 6 months on average. But sometimes it's shorter, but it's like average 3 to 6 months. But you want to make sure you don't have someone dragging out for 18 months. There's really a problem there if that's what's going on. And then the third thing is they have open communication. So where is the client at? Do they use the law to try to get things removed from the credit report, or are they just sending out letters and hoping and praying? So those, you really want to make sure communication is open. They have that law piece, and that they're not charging the client month to month if something happens or not. Very, very important.
I think the tough part too with those ones that are monthly and that go those 18 months to 20 months, like you said earlier, that the collections are a black eye for 24 months. So they're getting closer to that 24 months and their scores are going up, and the credit repair company's like, yeah, that's because we're doing our job. And really it's just time, right? Like we're dealing with
yes, that is exactly.
It ables to get them, you know, testimonials of, look at what we did. We took them from a 580 to a 720, when really all the client did was just do what they're supposed to do on their credit and pay things off or pay things on time. And, you know, that becomes a really difficult piece.
Yeah. The other thing that I'm really floored at, and I don't know if you guys have it in your area, but in my area, there's a commercial that says, I won't say the credit repair company, but they say, I can't even believe they said this. We guarantee your points will go up 40 or more. You can't guarantee anything. You don't know if they're going to, let's say it's disheartening when it happens, but there's clients that will be cleaning up their credit and then they get a late on their auto loan. And we're like, what on earth happened? How did their scores drop by 80 points when we're sitting here cleaning them up? And then you look and it's because they have a brand new late. So anytime that they guarantee anything, that's kind of a red flag that, wait a minute, that I've been doing this long enough, almost 12 years. Like, you can't guarantee anything. I can guarantee we're going to work our booties off. Other good ethical credit repair companies can guarantee they're going to work very hard to get things removed from the credit report. But there's so many factors that would be like me being like, oh, I live in the Midwest. I guarantee we're not going to have rain or snow in May. No, I can't. No, I can't. It's ridiculous. There's too many factors. So yeah, so it's very important that you do your research. Don't just meet somebody and be like, oh, they seem great. You really need to do your research. Okay. So last but not least, this is really, really cool information, and this really helps consumers. So fast credit score jumps. Let's say you have someone with a very thin credit profile, or you have a couple, let's say that one is very thin and the other one is not. An excellent way to jumpstart your credit journey is to sign on as an authorized user to a credit card. Now, the important thing is a credit card needs to at least be 12 to 24 months old, low balances, and good pay history. The older the card, the better. Now, I have 5 children. Some of them are getting adultish. Or I guess actually they are adults. I would be offended if I were their age and said adults. So 24, 22, 20, and I have 16 and almost 13. So when my kids were 18, I signed them on as an authorized user on my credit cards. They instantly had 7 years, boom, of history. I would never in a million years, and I love my children, just probably like if you guys have kids, you do too, you'll do anything for them. I would do anything for them. I would not be a co-signer. I would not co-sign for anybody. What you can do that's even better than that is if you sign them on as an authorized user to one of your credit cards, they have instant history, right? They don't need a co-signer most of the time. So it's a great way. You don't even have to give them the card. When I signed my kids on, now the cat's out of the bag. The big ones told the little one, so now they know that's going to happen. But when you sign them on, I didn't give them my card. I didn't say, hey, guess what? I just signed you on as an authorized user. I didn't have to wait till they were 18. There was just no reason for them to have any type of credit of their own until that point. So people are like, oh, when they hear this, should I sign my 6-year-old on my credit card? You can, but she's probably not going to be, or he is probably not going to be applying for credit anytime soon. And it's not like that gives them a jump start. Keep that credit card open the entire time. And then when they turn 18 or when they're starting their credit journey, sign them on, and then they have all that history. So it's excellent. It's excellent for partners to help each other with that. Let's also say that you have you're trying to get somebody, we got to get them approved, and maybe husband or boyfriend has a thin credit profile, but the other partner has really good credit. They can like piggyback off of each other. Let's say they each have 1 credit card each. They can piggyback off of each other. Now they have 2 credit cards. See what I'm saying? So there's a lot of ways you can think outside the box, but becoming an authorized user on a credit card is an excellent way to jump-start your credit. And then you go and establish your own credit.
I have personal experience with this as well. My wife, I came out of college with a TV that cost me $450 up front that ended up costing me $950 because I had that interest free and didn't understand that whole aspect. Yeah. And so like I didn't have very good credit. And so we did that. My wife had a card at that time that was open, for 4 or 5 years at that point. So that's what we did. I added as an authorized user, and then I was able to get my own credit card that I've had open since that time that I was able to get that open. So now obviously scores have increased quite a bit, but it's definitely a way that's fast to use. Now there is a caution on that. especially when applying for a mortgage, because those can be viewed as not really trade lines. So it's not really creating credit history for you. It's not really credit history that you can use, except to trick other credit cards into getting you a card up front.
Mm-hmm. Yeah. Yeah, exactly. And so what happens is that way you can, because a lot of times when you go in to apply, for a credit card or anything, they're like, oh, you don't have any, we don't know if you're at risk or not. So we're going to back up and we're not going to approve you. So it avoids all of that. So you can start your own journey. That's what I always say. You can't think that you can become an authorized user on grandma's card and then you're going to get approved for a home loan. Okay. Yeah. It is a tool and part of the big picture of what you can do to start that journey. And so, and like my daughter, when she went to go get her own car that I didn't have to pay for anymore, she had good history because she had my credit card on there as an authorized user. Then she opened up her own card about 60 days later. So she had this. So she looked like she had a 7-year-old card and a 2-year-old card. And now she has a car payment. So it really helped with that as well. So it's a tool, like Ryan was saying, it's part of, what you can do to get started. Now, let's say that you don't have anyone that you can become an authorized user on their credit card. You don't have that ability. Then the next step would be to go talk to a local bank, or we even have, there's all kinds of stuff you can find online. Read all the information before you sign up, but you can become, you can get a secured credit card. So secured credit card, you're putting down like, let's say $300 and you're basically backing yourself. I'm safe because if I don't pay this, you already have my money. Now I have seen where people become they do the secured credit card and they think because they put that money down that they already paid. They're not paying their monthly payment. So I just had one about 6 months ago. They're like, no, I put money down. And it's like, no, honey, you're just backing yourself. So you're basically being your own bank. Hey, I know I'm not at risk. And if you don't pay it, then they take that money. So you just pay it like it's normal. And then also, let's say you have credit established and you're kind of like sitting at that 630 mark. You're really trying to get that jump in scores. Pay your credit card balances down to that 3 to 5%. It is an excellent way to jumpstart your credit. Now, let's say that you have 4 credit cards and you just don't have the money at this time to pay all your credit card balances down. What I want you to do is I want you to take the oldest card that you have and pay that one down as low as possible. Try to get all your credit cards at 30% or below, and then take your oldest card and pay it down. The only fine print I will tell you, or the only time that I'm going to tell you it would be better to do something different, is if you have a brand new credit card. If you have a credit card that's 24 months or less and it's maxed out, that looks really, really bad. And you'll even see where on your credit report for the reason codes, it'll say you have a new line, basically a new credit card, your revolving line maxed out. So that's the only time I would tell you to go to the newest card rather than the oldest card if it's 24 months or less and it's maxed out. So hopefully I'm making sense there. But credit cards are a fantastic way to manipulate a FICO score in a positive direction. And remember, the older the card, the lower the balance, the better your FICO score is. Okay. The older the card, the lower the balance, the better its FICO score. And then, of course, remove any collections. Like I had said, if you call the credit card company and negotiate, like I had mentioned, then that's an excellent way. Because the cleaner your credit is, obviously, the better your FICO scores are going to be. And then the better interest rates you're going to get. And that's what we're all trying for, right? So then you can spend more money on the actual house instead of the interest. So that is that. Ryan, do we have any questions or anything that I maybe have not thought of that you've ran across with clients?
Yeah, we've got a question here from somebody. I'm not sure who it is, and I couldn't find it on Facebook, but we'll pop it up. And it says, "Hi, Janna, great information. Thank you so much. Not to backtrack too much, but a few questions about collections. How can a paid collection be removed? Is there a time frame after which it drops off? And what are the last active time frames for different types of debt as far as collection reporting?"
That is an absolutely excellent question. So typically when you pay a collection off, that's going to stay on for 7 more years. That's why it's so detrimental and it's really terrible. And it's just like a new collection. It's going to harm for 24 months and then start easing up. It is a big, big black eye. So basically you healed a broken leg and then you went out and you broke it again if you pay it. So let's see. I'm glad I can read this because I'll forget questions. Let's see. All right. A paid collection getting removed. I don't like to say, I dropped my wedding ring. Hold on. Okay, I found it. I don't like to say that it is impossible. I don't like to say anything's impossible, but it is nearly impossible to remove a paid collection. The reason why is because there's no benefit to the collection company for taking it off. There's no other nice way to say it. They don't care. So they're not going to mess with it. Every once in a while they will, but it's really, 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 really incredibly tough.
And is that because they stop reporting then when you pay it off? They don't continue to report the information, or?
You know, I've questioned that myself.
Because they still have to pay to report it, right?
Yeah, that's what I don't understand about it. Anything that you report on the credit bureau cost. And I know they do it like they lump it up and say, okay, we're reporting, you know, these 1,000, you know, clients and put it on there. But I don't understand, to be quite honest with you, what their big beef is about that. I would think, hey, we got the money, let's remove it. But they don't. I mean, it's nearly impossible. It's very difficult. That's why it's so important. Like when someone's like, oh, I'm going to pay this collection off, I get so accidentally passionate and maybe a little ridiculous when I'm like, no, like jump at them. And they're like, all right. And it's because it just causes so much damage. Is there a time frame after which it drops off? Okay. So it'll last once you pay it, you know, for 7 years. It really does significant damage for 24 months. And then it starts easing up after that. After 5 years, it's probably not causing a lot of issues anymore. So that's a good rule of thumb. Let's see. And what are the last active time frames for different types of debt as far as collections? It's going to be, they say 7 years in general, but it's really, I think it's like 7.9 months or 7.5. I'd have to go back and read. But anything negative on your credit report is going to last for a while. You know what's crazy about that too, which I think is so incredibly ridiculous, is like, let it go. Like even in marriages, when you jack up, like after 4 or 5 years, your spouse kind of starts forgiving you or like forgetting. These darn collection companies and bureaus are like, no, 7 years, nope. Like, come on.
Well, and then, yeah, and they tell you 7 years. And then, like you said, it's just a little bit longer than 7 years. So everybody's like the expectation of it being dropped off. They've always heard that 7 years. And then some things are 10 years, like bankruptcies don't they show up for 10 years. So,
you're right.
You know, there's a lot of things in there that, like, there's just different time frames. And, you know, like that's what was so great about, you know, and why I wanted to bring you in for especially this class. It's just those credit misconceptions. Like everybody thinks that, you know, it's just things that people have tried to guess at for so long that it's very difficult to put them into perspective and actually have, you know, true information. Yeah.
You know, the other unfortunate thing is you'll notice, and it doesn't happen as much as it used to, but a collection company, like right when the collection is like 5 years old, and they really at this point realize like this dude is not going to pay this off. Little tiny collection companies that are like the guy in the basement or whatever will buy these pennies on the dollar and then re-report as if it's brand new.
And as a different one, right?
Yes.
So then both are on there?
Yes. Yeah, that happens too. Yeah. So sometimes the other one, well, yeah, so it'll be sitting there and then now you look like you have another one. So you'll see, and usually what we're trying for is they'll be very similar in the dollar amount and things like that. So, and then you send out letters and you're like, can you verify and validate this is actually, you know, different and all this kind of stuff. But there's a lot of things out there that are very unethical that happens.
And that's what we need you for.
Gotta know your rights.
Yes. Did you have more stuff to put on your screen? Or are you good on the?
Nope, I'm good on that.
Cool. We didn't have any more questions that popped up, but we did have Jason Childers said, great job and wonderful information, Ryan and Janna. And he is also a Southwest guy. And then one of my friends from back in college, who is also a loan originator, said, good stuff, guys. So we've got
thank you, Andy.
Some and he's also a next level. So so you've got some good people watching and commenting. I don't see any other questions, so I think we'll go ahead and we'll finish it up there. But I appreciate your time, Janna, and I'm looking forward to next week to start all over and do it all again.
Yeah, absolutely. Looking forward to it.
What's the topic for next week?
Next week is how to turn turndowns into, turn denials into loans in 120 days or less.
Awesome. So we'll have some good information about rebuilding credit and helping people get some things removed and all of that stuff. So awesome. Thanks a lot. And we'll see you next week.
You have an awesome day. Bye, guys. Thank you.